Hi, you're welcome to this episode. We'll be looking at the content of preparation and reporting of financial statements. In the previous episodes, we had looked at the description and purpose of accounting, forms of business organization, identification and users of accounting information and opportunities in accounting, uh, and we explained in the very last episode the ethics in accounting and principles of accounting principles, generally accepted accounting principles, GAAP. So the reference textbook is the 17th Canadian edition, Fundamental Accounting Principles, Volume 1, by Larson, Dieckmann, and Harris. So in this episode, we look at the final part of the chapter 1, which is the accounting in business, and the final part has to do with the accounting preparation, financial statements preparation, which we'll be looking at in details today. Plus, we'll delve briefly into the accounting equation. The objectives for this episode would be to identify and explain the content and reporting aims of financial statements, analyze business transactions by applying the accounting equation, prepare financial statements reflecting business business transactions. Financial statements, what are they? What do they involve? They are an organization's primary means of financial communication. They are transactions that are recorded, classified, sorted, summarized in order to produce financial statements. So that means, in essence, transactions must happen. Then they are recorded, they are analyzed, they are classified, they are prepared, they are interpreted and communicated to users. There are 4 main financial statements, and they are the income statement, balance sheet, statement of changes in equity, and the statement of cash flows. If you look at this critically, you see that there is a period of time that is covered in these statements. In the very previous episode, the last one before this, we looked at the generally accounting principles. One of it is continuity, going concern principle, which says that account is prepared for a business with the belief or assumption that the business will continue to perpetuate it. So that means this accounting preparation is for a period, so which is presumed that there would be next period of business existence. So, and these are the 4 statements: the balance sheet, the income statement, the changes in equity, and statement of cash flow. The income statement reports revenues of the organization, the expenses of the organization, and the net income or loss. Revenues are what the earnings generated, and expenses are incurred. So revenues minus the expenses would give you the net income or loss. If the expenses are greater than the revenues, that is net loss. If the revenues are greater than the expenses, that is the net income or the net profit. The income statement shows revenue, like a school, for instance, the teaching revenue, equipment rental revenue, sales of inventory. They are general revenues of an organization. So those revenues less expenses, the rent expenses, the wages and salary expense, the transportation expense, communication, advertisement, and other operating expenses would be deducted from the revenues to get the net income. Costs are incurred, as was said earlier. Revenues are earned. Now, the second financial statement is the statement of changes in equity. The first one, as has been explained, is the income statement, then the statement of changes in equity. Equity is equal to total assets minus total liabilities. Equities are owners' investments. The proportion of owners' stake in a business is equity. So it represents how much of the assets belong to the owner. Owner's equity increases with owner's investments and net income. So when there is net income, equity increases. When there is net loss, equity reduces. Owner's equity decreases with owner's withdrawals and net loss. So equity at the beginning of a business year would be increased when the owner has additional investments or with net income. It will reduce with withdrawals of the owner from the business worth and would reduce further by net loss. So investment by the owner at the beginning, or the one you have at the beginning, would add the additional investment by the owner in the period. That is not fixed. That doesn't happen every time, but when it happens, it's added to the beginning owner's equity. Net income would increase it, then withdrawal by the owner and our net loss would reduce it to give us the closing equity. So the beginning equity in this case was 0, which is usually for a business that just starts its existence, its financial year. So equity would be here, or when the owner has not provided anything here, and in the course of the year the business has investment added, additional capital. So whatever amount at the beginning plus additional investment by the owner plus the net income less withdrawal less net loss would give us the closing equity or capital in this case. Having explained the changes in statement of changes in equity and income statement, the third one is balance sheet. The balance sheet reports the assets, liabilities, and owner's equity. So basically, you can summarize balance sheet as the list of business sees assets, liability, and equity as at a date. So, or at a point in time, it is linked to the statement of owner's equity. So let's look at this. It shows assets. Assets are resources owned or owed to a business, owned by a business or owed to a business. So cash is an asset, supplies, equipment, account receivables are all assets of a business. Then liabilities are obligations of a business to third parties, debts or indebtedness of a business to outsiders. Any amount that is being owed by a business is a liability. So account payable, note payable, or loans, they are liabilities. So liabilities, assets, when we deduct it from assets, gives us equity. So that means the total asset here is 18,000. The total liabilities is 6,200. That means the total capital or equity is 11,800. If you add liabilities to capital, it will give us 18,000, which is the same amount as total assets, which means total assets is equal to liabilities plus capital, or liabilities plus equity. Liabilities have been explained already as debts or obligations of the business to outsiders, to third parties. Any amount that is being owed by a business is a liability. Owner's equity is owner's claim on the assets. That's the part of the owner's stake in the business. Then assets, resources owned by the business. So the fourth financial statement is the cash flow statement. So having already explained the income statement, the statement of changes in equity, the balance sheet, now cash flow statement, which reports the sources and uses of cash for a period of time. Now, organized by the company's major activities, those three major activities are operational or operating activities, investing activities, and financing activities. So, this is an example of a cash flow statement. Vertically inclined rock gym cash flow statement for the month ended March 1, 2014. Cash flows from operating activities as cash received from clients, cash paid for supplies, cash paid for rent, cash paid to employees. If you'd notice, from these activities that have been read here, they are activities that are shown in the income statement. Remember, for the expenses, we looked at the expenses like rent, and we looked at the movement of here we look at the movement of inventories, that of course also shown in the income statement part. So we look at cash moving through operating activities, through inventory movement, through debtors movement, through creditors movement. For instance, if debtors reduce, that means there is a cash inflow. How is it so? It means that some debtors have come to pay the business. If creditors reduce, that is the opposite of debtors reducing. If creditors reduce, that is a cash outflow. It means you have paid the creditors, so you'll be owing them less. That is a cash outflow. So that is done or showed in the operating section of activities. Then you look at the cash flows from investing activities, add cash flows from financing activities. Investing activities stems from purchase of assets, purchase and disposal of assets, investment in other businesses, and interest received from investments. Those are investing activities. Then financing activities stem from loans and issue of shares, or dividends paid on issue of shares, or interest paid on loans received. These are financing activities. Basically, when you see financing activities, we're talking of the sources of finance, and they show the sources you've got and costs you have incurred on those finances, or the payment of those finances, or redemption of those finances. Like loan, when you're paying loan back, is under financing activities. When you obtain the loan, is treated under finance activity. When you bring issue shares, is financing. Dividends paid in issue of share on the issued shares is still under financing activities. So we've talked about the four financial statements: the statement of cash flow, the statement of changes in equity, the income statement, and balance sheet, which is also known as statement of financial position. Lastly, for this episode, we'll look at the accounting equation. Accounting equation is assets equals liabilities plus equity. Assets are resources owned by the business, so they describe properties of value owned by the business or owed to the business. So, like cash, supplies, account receivable, equipment, land, building, properties, they are owned by the business. Account receivables are owing the business, so owed to the business or owned by the business are assets. Then liabilities, they describe obligations due in the future to creditors who have a claim to assets, like accounts payable, notes payable. Loans, they are indebtedness of the firm to outsiders and are to be paid in the future. So that means the ones that are to be paid in the very short or nearest future, which is within the next 12 months are called current liabilities. The ones that are to be paid in a later time, like after 1 year, are non-current liabilities, like long-term loans. That's an example of long-term liability or non-current liability. Equity, the last one, describes the owner's rights to the firm's assets or net assets after all liabilities have been deducted. They are like invested capital and retained earnings. Any form of owner's right to the firm's assets, owner's stake basically in the business. So owner's worth in the business is the equity. So the accounting equation is used to keep track of changes in a company's assets, liabilities, and equity. And finally, for this episode, business transactions cause changes in assets, liabilities, and equity. So, having the summary of this episode today, we looked at the explanation of financial statements and the preparation of each of them, examples for each of them. That's the income statement, the statement of financial position, the balance sheet, and statement of financial position is the same as balance sheet, statement of cash flows, and statement of changes in equity. There are 4 financial statements. Then we look at the accounting equation. Assets is equal to capital plus liabilities. In the next episode, we'll be looking at effects of accounting equation on effects of transactions rather on accounting equation. Every time there is a transaction, there is an effect on accounting equation. That will be our next topic in the next episode. If there is any question on this part, please make it in the comment. Thank you very much and see you the next time. Bye.